Hi, everybody. This is Dan Sheridan at Sheridan Risk Management. And today I'm going to cover two types of combo trades. I'm going to tell you what is a combo trade, uh, why do I do combo trades? Been doing them for a while, but why do I do them? And when would I do them? So let's start with an example. I'm going to give you two examples. The first example is going to be a Cal fly. Uh, and a Cal fly is a combination of a calendar and a butterfly. And if you look at this example, you can see the calendar. The calendar is at 64.10, and you can see the logistics. We're at 64.66. I'm going out about a couple weeks. I'm selling a SEP 5 64.10, buying a SEP 9 64.10. So this would be an out of the money put calendar. The price is at 64.66 in this example. So I'm doing a bearish out of the money put calendar. And then on the upside, I'm doing uh, I am doing a balanced butterfly at the 65.20 strike. And you can see that here. I'm buying 164.80, selling a 265.20s, buying 165.60. The distance from the short to each of the longs is about 40 points. And in both of these, the calendar is about 535. The butterfly is about $6. It's about $1,100 trade. So you have kind of a Batman type thing. It's a combo. So first of all, let's attack what is a combo. A combo is just two individual trades here. I mean, it doesn't always have to be a combo is kind of two pieces. You would look at it, you could look at it as two individual pieces. You have a calendar on the downside and you have a fly on the upside. Right. So that's combo two, right? And it gives you a wide area. If the underline's at 64.66, you have kind of a wide area of which are okay. Deltas are relatively flat. It's a positive theta trade. So it'd be a range bound type trade. And the Vega, your volatility risk is pretty close to zero. 17 is pretty, you don't have a lot of volatility risk. So you have a wide range. So that's what is a combo, two trades. When would I use it? Why combos? I usually use combos when I'm doing something, could be 4 days from expiration to 13 days, maybe a shorter term trade and when you get in shorter term trades, they have more price risk. So instead of, maybe just doing a calendar butterfly at the money, I want to get more room. Why? The price risk. So when do I usually use these combo trades? A shorter term duration, like 4 to 12 days or something like that, 4 to 13, 14 days. And and when would I do it? So I'm giving you the duration, so shorter term duration, I want the wider swath, right? Start getting 3 weeks out, 4 weeks out. I'd rather just do a butterfly or a calendar at the money, right? Um, but when the price risk increases as you get closer to expiration uh, in this 3 day to 13-day window, I want more room. I want to spread out my individual strategies. And so you can see, and the other reason you would do a combo is, let's say you want to trade where the volatility is closer to zero like this. So if you look at these individually, you have a calendar, which is long Vega, 69, and a butterfly is short Vega. So you want these. So when would you want that? Well, when I don't want volatility risk. Maybe I'm not comfortable with where the volatility is to the fact that maybe I want to be a little bit long volatility or short volatility, I'll be closer to neutral. Now, if you asked me with VIX at the lowest levels in 2023, 2025, I don't mind being a little bit long Vega. So I might be a kind of a double calendar, double diagonal type trade. So this is a combo for those who want to be a little more neutral volatility. And you're only two risks with any of these range bound trades or price and volatility. So you're negating one of your main risks, volatility. You still have price risk in these shorter term, relatively shorter term trades, but that's why we're doing a combo. We're moving them, we're getting more room to handle it. Now, the other combo trade here, this is the flagonal trade. You start out with and this is just going to be more expensive, right? How I structured it. The butterfly in the calendar about 1,100. This is getting close to $1,900 because I'm using a broken wing butterfly here. You can see, again, I'm placing the short, same, 65.20, but I'm making it a little wider. My long is 50 points from my short, but my other out of the money call long is only 40 points away. So I'm trying to reduce my risk on the upside. You can see, so I'm leaning 3 deltas long on my butterfly. This is a broken wing butterfly, as opposed to I used a balanced butterfly in the previous example. And then I'm going to use a diagonal on the downside instead of a calendar. And you can see I'm selling the same strike as the calendar, 64.10, but I'm buying a further out expiration and a strike like 10 points up here. So you can see in this example, it's more expensive. Similar results, very low Vega. It's going to cost me more money, give me more, a little bit more room, I guess you could say. And the deltas are close to neutral. So I just want to kind of introduce you into this, the world of doubles. Starting in September, on Mondays and Wednesdays at 2 p.m. Eastern at Sheridan Risk Management, we're going to dedicate a whole month. We'll have a course live. We'll be doing live trading from 2 p.m. We'll go about an hour Mondays and Wednesdays. They'll be recorded on the subject of doubles, double strategy, which is a very effective range-bound trade. And you can check us out at SheridanRiskManagement.com. We'll have some information on that. So folks, have a great day, and we'll see you later. Thanks.